Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. As the lead-in indicated, this is a different take on the investment show. The objective here is not to provide investment advice. I'm not a licensed investment professional. Rather, I'm a securities attorney who dedicates my practice to representing investors in claims against brokerage firms. And the objective of the show is to pass along some of the information that I've gleaned from that practice that I think would be helpful to investors out there as they navigate the investor-financial advisor relationship, and hopefully pass along some wisdom so that you can avoid becoming the victim of a securities fraud, and so that you can improve your relationship with your financial advisor, be asking better questions, and just be better informed and have a better understanding of sort of the perspective of the brokerage industry, how they come about, the recommendations they're making, and the things to be on the lookout for. So each week we'll tackle various topics that sort of flow from that background with the hopes to pass along some information that would be valuable to you guys. A lot of the times we spend on the show talking about things to avoid. This week I thought we would focus on things to look for, as opposed to, sort of here's some red flags if your financial advisor is recommending, XYZ strategy that might be problematic. Here's some questions to ask. Instead, I thought I would go into some greater detail about the types of strategies that you should be hearing about. And maybe that will be the red flag, because if you're not hearing these types of discussions with your financial advisor, that might be problematic. But, at the end of the day, I'd say 99.9% of the cases that we work on, at the nexus of those, at the very root of them, is this crossroads between commissions and greed, where you have a financial advisor who's recommending a portfolio or an investment because of the commissions that it generates for them, as opposed to it being necessarily in your best interest. And as we've talked about in previous episodes, there's this huge disconnect between the investor's understanding of what the financial advisor's obligation to you is, which, to a person, every person I've spoken to assumes that there's a fiduciary duty there between your financial advisor and you. And what the financial advisor, their perspective on that, which is that their obligation to you is simply to make an investment recommendation that's suitable. And where that becomes problematic in the context of investment advice, and certainly securities fraud, is that the difference between an investment that is in your best interest versus an investment that is suitable is that a financial advisor, let's say you want to be invested in the financial sector, and you think that that's got, very promising prospects for this year, and you want to be in some bank stocks. A fiduciary relationship would require that the financial advisor make a recommendation that is lowest cost, best suits that investment objective, is most in line with your risk tolerance, et cetera, et cetera. But the cost one is the biggest component there. They'd have to look for, whether it's a low-cost ETF or, a mutual fund that has low fees. They would have to take that into consideration. Whereas with the suitability standard, what you see is that the recommendation, there might be a whole cross-section of investments that meet that objective, that provides investments in bank stocks and exposes you to the financial sector. But the commissions might be very different in those products. Maybe you're talking about a unit investment trust that would pay the financial advisor an upfront 4% fee. Maybe he's going to accomplish this by putting you in a variable annuity that would pay him 4%. Maybe it's a front-loaded mutual fund. Whatever the product might be, he might be picking one that is quote unquote suitable for you. It accomplishes, the fact that it does invest in the financial sector and gives you those bank stocks you're looking for, but while also paying him the highest commission. Maybe it's a proprietary product that was put together by his own bank, and pays him, an extra basis here or there for pushing their products. But that's where the vast majority of the stuff that we look at comes from is that disconnect, where you've got a financial advisor who, in theory is making recommendations that are suitable, but isn't doing so necessarily in your best interest, but instead is focused on those commissions. So, that's the thing to be on the lookout for. But in terms of the objective of the show, what you should be hoping you hear from your financial advisor is, I consider myself to have a fiduciary duty to you, number one. Number two, what hopefully you're hearing some discussion about in terms of strategy for investing would be what's called your modern portfolio theory. And there's a lot of academics out there who have written papers about this, but at its most simple, modern portfolio theory is basically a discussion of reducing risk through diversification. And I think most people, have some understanding of what that means. And basically what that means is don't put all your eggs in one basket. But again, going back to the commissions being the motivating problem, what we see are where the bad financial advisors push products, get away from modern portfolio theory, get away from diversification because they're maximizing commissions by putting you in some high commission product that, maybe it's now all of a sudden 30, 40, 50% of your portfolio. And they tell you, but it accomplishes your goal because it's low risk and it provides income or whatever it is that you're looking for. But once you deviate from that basic modern portfolio theory, you've now increased your risk exposure by simply just having half of your money in one particular, type of investment. And that doesn't mean it's going to go bad. The vast majority of bad portfolios out there don't end in litigation because, look at 2014, the market was up 30%. You could have been up 20%, but that doesn't mean you're going to sue your financial advisor. But it might mean you had a portfolio that wasn't well diversified. It might mean that you had deviated from modern portfolio theory by investing, too much of your assets in one particular segment that didn't do particularly well. And the other benefit to modern portfolio theory, when you get away from the years where everything is going great, is when you start talking about the years where things go poorly. That's where diversification really becomes key. Short of, at least in my lifetime, short of 2008, where virtually everything did horribly. But generally speaking, when you start talking about your garden variety market correction, and a market correction is defined as 10% decline from the most recent peak. So anytime you've got a market correction of, say 10%, if your portfolio is well balanced and diversified, you're probably at least tracking that, if not doing a little bit better, depending on how bonds perform during that same time period. Because generally, if we're talking market corrections in the news, they're looking at the Dow or they're looking at the S&P, which are both equity indices. So if you've got a well-balanced, diversified portfolio that includes some bonds, includes some cash, has some equity exposure, generally speaking, if the market is down, you should do a little bit better. And if the market's up, maybe you're not doing quite as well because now you've got some hedge and some from your risk exposure there. But the point is that if you're not hearing some of these discussions from your financial advisor, that might be a red flag, because the reality is most academics will acknowledge that modern portfolio theory is the best way to reduce risk, just through by nature of just diversification. And again, at its root, I think most people understand it. You don't want to put all of your eggs in one basket. You don't want to have, regardless, Apple stock. Apple's was, as of last year, the biggest company in the world, and they make great products. But you wouldn't want to have had your whole portfolio in it over the last 6 months because it's down 25, 30%. It's still a great company. But, we've got China slow down. We've got sales of iPhones slow down, and suddenly you've got a huge risk exposure there. Even though it's still a great company and still has great products, you might be down 25, 30% because you didn't diversify and buy some other things. Obviously the goal is that you get to a point where some things go up, some things go down, but overall you're still, going up, tracking the market. And if you go to our website, wallstreetvmainstreet.com, we've got some of those academic papers under our research tab that you can read at and get a more a thorough breakdown of modern portfolio theory and sort of its basics. But again, those are some of the things that you want to be hearing from your financial advisor in terms of the plan. Here's our long-term goals. Here's what we're trying to accomplish. And here's how we best get there. And here's how we best make sure to avoid unnecessary risk for you. And again, it should be, I've heard it, financial advisors talk about, we're going to have different baskets. We're going to have, diversification. We're going to have, varying types of assets. But these are all discussions that you'll hopefully be hearing from your advisor, because there is no product out there, no investment out there that is perfect for everyone, and make sure that you don't lose any money regardless of what happens in the market. I mean, again, the Apple example is one, but any investment, whatever it is, there's still market exposure. And so you want to avoid that by spreading things around, diversifying your own exposure. And also, you're probably going to want to do that by not necessarily giving all of your money to one financial advisor. And I'm not suggesting that you have, financial advisor relationships with, 3-4 different brokerage firms. But, most people own their home and they've got equity in their home, and that it can be a hedge away from your stock portfolio, because that's further diversification. Now you're invested in real estate as opposed to just straight stocks. If you've got a financial advisor that's suggesting that you give him all of your assets, including, let's suck the equity out of your home and invest that because I can do better, those are red flags. Anytime you have a financial advisor that's just, gimme, and it's always asking you about your other assets and trying to get, their hands on those, that should be a red flag in of itself, because it just shows, a level of greed maybe that is disconcerting. But more importantly, there are assets away from brokerage firms that you can invest in to even provide even greater diversification for your overall, portfolio and assets. So, keep those things in mind. The other thing that you should be hearing from your financial advisor is some discussion of how they're being compensated and how that impacts performance over the long term. There's plenty of studies out there that discuss how paying too much in commissions can impact your portfolio over the long term, and how it's important. Diversification is one way to protect your assets, but reducing cost is another. And so if you're not having some very frank conversations with your financial advisor about how they're being paid, that's a red flag, and you want to follow up with them and ask them the question. And if they won't give you a straight answer, that's something that would require further conversation. One thing that we hear a lot of times when that question is asked from some of our clients, did you ask your financial advisor what they were being paid? And a lot of times the answer is, oh, don't worry about it. I'm being paid by the company. I'm being paid by, either the mutual fund or the sponsor of the private placement investment, or whatever the particular investment might be. Don't worry, you're not the one paying me. The company's paying me. And while that is technically true, they're paying that financial advisor with your money. So ultimately, you're still the one paying them. And that's sort of a artfully crafted response to avoid the real answer to the question, which is, how much are you being paid for this recommendation? Because, whether it comes from the company or directly out of your account, it still impacts the performance of your investment. And to give you just sort of and there's literature on our website on this point too, and there's plenty of studies out there on this one, but to give you just a very rudimentary mathematical example of this, let's say you've got a 401k with your employer with $100,000 in it, and each year you're adding to that with $10,000, and you're paying the 401k manager 1%, and then the investments you've selected, you're paying, the mutual fund sponsor, whoever it is, a basis of, another 1%, which, to give you some comparison, the typical ETF out there right now, you pay 0.1%. And that's because, the reality of ETFs is there's not really an active management strategy that's happening. They've got employees, of course, that run it and make sure that they're tracking the indices, but there's not a huge, cost for them to do it. So they don't need a huge expense ratio. But so going back to our example, let's say we've got, we've got 1% going to the fund manager and 1% going to the administrator of the 401k. So you're talking 2%. On our 100,000, let's say the market goes up 10%, you track it. So now you should be at 110,000, except really you're at 108. And maybe you're okay with that because you don't really want to be dealing with it and you want somebody else to be managing your money. But in year 1, you're down 2, you compound it by year 10, 20, 30. I mean, if you're talking about your employer with your 401k, you're talking about a long duration. By year 30, that can make the difference between saving $500,000 and $800,000. It becomes that substantial. That difference between 1-2% of costs starts to add up when you just, the basic compounding theory of investing. And so, that's the significance of asking those questions. We've been talking about actually in my own office because some of the investments that are offered by our 401k have a high expense ratio. And, in the short term, that doesn't seem like such a big deal. Okay. We're paying 0.65% to the fund manager. And I'd like to be paying close to 0.1, but it's not the end of the world. But over time, it really is. It adds up. And so these are why it's significant to be asking those commissions questions. It's because, a lot of very smart people will argue that it is almost impossible to consistently outperform the market. So your objective should be to try to just track it and reduce costs. And as long as you do that, you're in pretty good shape. But if you're almost tracking the market, but paying 3.5% in commissions, suddenly you're not remotely tracking the market. You're actually grossly underperforming the market. And importantly, you're doing it every single year. And so by year 20, year 30, you're going to have substantially less than you would have if you had just reduced your expenses and tried to get closer. Which isn't to say necessarily that everybody should be in ETFs, but certainly there should be a conversation between you and your financial advisor about why are we picking this and what is the expense ratio and what are the commissions to you. If it's a product that's been created by his or her own company, why are you recommending to me that proprietary fund? Are there any others out there that are better? These are all conversations you should be having. And again, in a perfect world, they would be initiating those conversations because certainly it should be a large component of their strategy is, hey, okay, we're going to diversify you. We're going to follow some modern portfolio theory. We're going to spread you around in various asset classes, and we're going to make sure that we reduce costs. There's a couple of different models in terms of compensation of financial advisors. And it sort of depends, there's no perfect strategy, but it kind of depends on what you're looking to do. If you're a, very active trader, a commission model probably does not make sense for you because you're paying every single trade. If conversely you never trade, maybe a commission model does make sense for you because you're very rarely turning over your portfolio. But in my experience, the model that probably with a very broad stroke works best for most people would be the one where you're paying your financial advisor a percentage of the assets that he's managing. And the reason I think that works best is simply because that puts you and your financial advisor on the same team. We see that in our own practice, and the claims that we bring on behalf of investors against brokerage firms, we almost 100%, not 100% of the time, but almost 100% of the time, we do that on a contingency fee. And, I often had that conversation with the client that the benefit of that arrangement with them is that we're on the same team. I want to get as much money for you as I possibly can because that works out to be the best for me as well. And in the financial advisor context, the same would apply. You want to be having a relationship with your financial advisor where they're concerned about downside. They're concerned about risk. They don't want the portfolio to blow up because they're looking to have you as a long-term client where they make their, 1% sort of industry standard. They make their 1% and they want you, as long as they, as long as they're tracking the market and doing well and keeping you happy, they keep you for 20, 30 years and suddenly, they start doing really well. So that's, the sort of strategy that I think works most generally for people. But if you don't even know how your financial advisor is compensated, those are questions you need to be asking. And even in that model where they're making 1% for assets under management, you should also be having a conversation, okay, so now we've sort of locked in what you're being paid, but you still want to be talking about some of these other investments because, what are the expense ratios of the things that you're offering me? Because if they have high expense ratios, that's still going to be eroding performance and still problematic. So make sure you're having those conversations, and hopefully that's what you're hearing. These are some of the better practices that we see, because the brokerage industry is not unlike anything else. There's great financial advisors out there. I know many of them, and then there's bad ones. But there are a number of them that do it the right way. And in my experience, that's generally doing it the right way, where you've got some consideration given to diversification. You've got a lot of consideration given to commissions and how those can erode the performance over time. And then certainly, in most regards, you've got that model where they're on the same team as you. They want to protect you from the downside. They want to invest you for the future, and they want to keep you as a client by doing well for you. A lot of the cases we see, the model is a huge upfront commission. They stop caring about you as soon as they sell you the product because you're locked into it, and now they can't make any money off of you. You can't get them on the phone, and they make their huge, 5, 6, 7%, commission up front. That's not a good model for the long term. And so if that's what you're paying a financial advisor for, that, maybe those are investments that suit your portfolio, but I certainly would suggest that you ask some follow-up questions. So we're going to take a break, and then when we come back, I will provide a little bit more information for this week. Thanks.
You can trust Sandpiper Pest Control, serving Indian River, St. Lucie, and Brevard. Certified by the state of Florida to treat homes, lawns, and termites. Fully licensed and insured. Priced right, effective, and friendly.
Hi, this is Joel, the owner of Sandpiper Pest Control. Sandpiper can solve your pest issues. No contracts to sign, just results.
Call for a free estimate, 772-589-0204. Sandpiper Pest Control, a member of the iTex trading community. Your iTex dollars are welcome.
DuBose & Sons Jewelers. Inside, you'll find Mike DuBose sitting in the back, head down, wearing that weird little visor. You know the one. It has a magnifying glass on it. You see, Mike is a real jeweler, a master jeweler. Mike DuBose and his sons are experts, but they're also your neighbor. They'll treat you like family. Citizen watches, diamonds, necklaces, anklets, rings, special orders, and of course, custom pieces by master jewelers. DuBose & Sons Jewelers in the Colonial Plaza, Old Dixie, Vero Beach, between 8th and 12th Street.
Minuteman Press of Vero Beach, covering the Treasure Coast from Port St. Lucie to Sebastian, can handle all your printing and copying needs, from large format and blueprints to business cards and brochures, plus a full line of promotional products. Minuteman Press of Vero Beach. Google it.
Welcome back, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. Before the commercial break, we were talking in some detail about modern portfolio theory and the impact that commissions can have on the performance of your account. As I mentioned, we've got some literature on our website that's not our own creation. These are things that we found we've sourced from other places. But if you want to learn more about it, because obviously, given our time constraints, I could only touch on certain topics. But if you want to learn more about modern portfolio theory or read some studies on how commissions can impact your performance, check us out at wallstreetvmainstreet.com. If you want to learn more about our representation of investors in claims against brokerage firms, check out our firm website, which is whitesecuritieslaw.com. We're also on Twitter and Facebook and anywhere else really that you would want to find us. Tune in next week. We're going to be talking about new account forms, which undoubtedly are the most important documents in every single one of our cases, and some things that you should be on the lookout for when you're filling those out, because the reality is when you're filling out a new account form, you're at the beginning, everything's rosy, you have no reason to think, oh my gosh, 5 years from now I'm going to sue this guy. But certainly, there's some representations and there's some language that's in those documents that you should focus on when you're filling them out. So tune in next week and I'll go into detail about that. Thanks.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.